At BMO ETFs, all our investment tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we build solutions for the Canadian investor. So next time you invest, consider a Z instead.
Hey everybody, it's Larry Berman here. This is my poker face, and this is my surgically removed cancer face. Anyways, good news is they got it all. Very benign cancer, typical of golfers who spend a lot of time in the sun and stupidly don't use enough sunscreen. Crazy weeks coming up. We're in the dog days of the summer here, and it's going to be nothing less than exciting and volatile. Let's take a dive into the chart room and see what we learned this week. Market tried to cheer the inflation numbers this week. The super core index, that is Powell's favorite, ticked higher and is turned up. It's still less than it was earlier in the year. But it's definitely made at least a short-term bottom, turning up. So super core backs out rental cost and other things, and is designed to the real cost of goods for people that don't include housing in general. There's a couple other items excluded in there too. So Powell references a lot. Be interesting in his speech this week at Jackson Hole, what he has to say about perhaps the different components of inflation and what's putting him on pause, because the topic of the agenda this week in terms of the research that's going to be presented is really all about the dual mandate, the balance between inflation and jobs. When we look at the employment situation, this week, claims numbers were soft. When we look at other growth components this week, retail sales were higher than expected. So the economy's still going. Inflation, therefore, should go up. Tariffs are a driver of that. They're in between a rock and a hard place. Even Michelle Bowman this week came out and said, well, 50 would be way too aggressive. So, very quickly earlier in the week, the September meeting was starting to get priced with a higher probability of one rate cut, and by the end of the week, less than certainty. But 2 rate cuts or a little more by the end of the year. So, market expects the Fed to be moving here. What moves them is inflation being benign, but more importantly, the jobs picture staying soft. Doesn't have to get materially worse, but we know the trend of the last 3 months has been 35,000 jobs in terms of employment situation. The week of the 12th, which is this week, which will show up in next week's claims numbers, is survey week. Maybe surveying will be different in the future, given changes at the BLS. But until we see that, monthly payroll numbers and the current process is what we get. And we'll see this week from that perspective as well. No real big other things on the growth agenda for this week. Last week of the month, of course, we do get some growth type numbers. We get Nvidia earnings, Nvidia being the leadership, early April, tariff risks, $2 trillion company, and now it's doubled in size and it's a $4 trillion company. In the last 2 weeks, the market gapped, struggled, tried again, struggled. If the leadership of AI can't keep going, what hope does the rest of the market have? So TBD, but obviously the Nvidia earnings on the 27th, I believe it is going to be a major inflection point following the weekend after Jackson Hole, and we'll hear from the Fed. For this thing to break, there's two supports where we had the reversal 2 weeks ago, found support around 170. We had the reversal week before that, found support around 165. So 50-day average up in that range. We need to break through that to confirm the top, at least on an interim basis here in Nvidia. And that probably doesn't happen until we get into closer to earnings. We'll see what the vol markets are pricing in. There might be some interesting option activity around that event, to be sure. When we look at the inflation and growth aspect, that has everything to do with the long bond. And this week we failed to continue the pattern of higher lows and slightly higher highs, or almost a failed higher high there. But we're in this upward channel in the last couple months here. And until it breaks to the downsides, we would need to see TLT below 94. For me to get very, very concerned that inflation is taking off or bond supply is weighing on the market too much. Otherwise, slowing economy should keep this well supported. The risk of a slowing economy should keep this well supported, while at the same time, massive bond supply should keep this from getting anywhere above 92, let's call it. It's any point over the next 6 months. So we're range bound on the long end. That's good for lots of things. And it won't break to the upside until we see a hard economic landing, i.e. jobs market breaks. And it won't break to the downside unless we see inflation. Supply picture with the tariffs is getting a little bit better. I'm not saying it's bullish. I'm saying it's getting a little bit better, meaning that deficit financing is probably going to be less than feared until, of course, the economy falls. And then it's going to get worse, limiting the upside of a bond market rally here anyways. So when it comes to the S&P 500, again, higher high this week, bit of a breakout. Again, slight reversal on Friday, but we've seen that in previous weeks and the market just keeps going. So the buy the dip mentality is still ingrained in the market. We've seen no strong evidence of this trend being over yet. But I think we want to tighten up stops. For sure, 6,200 for longer term investors. We don't want to see a break there. For the trading types, I would trickle it up under this week's lows. So if we get back below, call it this breakout day here around 6,400, maybe a little bit below that, I would say we're going to see a 6,200 print. That's it, everybody. Hopefully markets behave and are quiet the last couple of weeks of the month, but I fear we're going to see quite a bit of volatility with people on vacation and a little bit less liquidity in the last couple of weeks of the month here.